Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, everybody. Welcome to this Wednesday edition of Benzinga's Pre-Market Prep. Spencer Israel here with Dennis Dick. Happy New Year, everyone. Good to be back. Feels like I've been gone for like 10 years. I was only gone for 10 days, but feels like I've been gone for quite a while, so it's good to be back. Hope you all had a lovely, relaxing New Year, but 2019 is not off to a great start this morning. We are in the red, so we're going to talk about that on today's show. Going to go through the top 10 components in the S&P 500. Going to talk about the continued saga of Afria, and we're going to be joined by Steve Sears at 8:35, formerly of Barron's, now the chief market strategist at Stratify. He's going to talk to us about a phrase I believe he is coining, the chaos trade. So that'll be at 8:35 with Steve Sears. Dennis, long time no talk. How's it going, man?
Yeah, I know. When I take one day off, Spencer, I feel kind of lost. You've been taking like 2 weeks off here, man. You got to be like, you're got to be rested anyways. Are you rested?
No, I need a vacation from the vacation.
That's one of those.
What it is.
You did one of those like Chevy Chase vacation.
Yeah.
Like you're everywhere. Tell us about your holiday.
All right. Started off in Michigan, of course. We drove down to Cincinnati for a day, drove east to Pittsburgh for a day and a half, drove further east to D.C. for 3 days, stayed in the D.C., Maryland, Virginia area for a couple of days, drove up to New Jersey after that, then on to Long Island, back to New Jersey, back to Pittsburgh, and then yesterday back to Detroit, the Metro Detroit area. So a long trip.
That sounds like a lot of miles. How many miles on that car?
Yeah, it's about 2,000 miles.
Wow.
Yeah, so it was a
busy holiday.
Long trip, a lot of driving, but it was nice. Got to see a lot of stuff, see a lot of friends and family. So it was all good in that area. How was your New Year's, man?
Yeah, it was good. I actually went to a few friends' house in Toronto there, had a very good time. Toronto housing price is still crazy, just talking to like my one friend, and they've come down a little bit there, but just telling me like what these houses are worth, and it's like every single house. He's like, you can't get a house for under $1 million, not anywhere in the Toronto area.
Really?
And I just keep thinking, I was like, wow, man, that like Canadian housing bubble is just so inflated still, and you're really worrying. I just get thinking, man. And the Canadian markets obviously haven't performed well in the last few years. And I've been saying, a lot of their money is all tied up in their houses because the housing market is so crazy, especially in the bigger cities like Vancouver and Toronto. But you hear about, like you're talking like 2,000 square foot homes going for $1 million. It just seems like, can it last? And then we know what happened in 2007, 2008 in the U.S., obviously, it was the housing bubble that started everything, and Canada's set up the same way. Interest rates coming up, oil's in the gutter, the housing bubble is still existent there. You worry about those markets, especially Canadian markets as well. So anyways, gives you a little perspective, and, and they've said, housing prices have come down quite a bit, but really when you put it in perspective, houses that were worth $500,000 5 years ago now over $1 million. So I just don't think it's sustainable. But anyways, that's a different market. We got to talk obviously the stock market as well here.
So, yeah.
And we were greeted this morning with a significant sell-off. Call it profit taking from last week, or call it risk management here from longer term investors maybe coming in saying I'm going to sell into this rally. That's what we're seeing here this morning, and it's not pretty out there.
So fill me in, Dennis, because I was in D.C. on Wednesday, which was, I believe, the day we had that big rally. So fill me in on this sentiment from the past couple of days and how that factors into today.
I mean, when you were away, okay, so we were very oversold. We knew coming in, the Christmas Eve sell-off kind of felt almost like this is like a little bit of the short-term washout, and it turned out to be the case. We were down for like 7-8 consecutive days, talking down 3,000 Dow points or 2,500 Dow points in a week and a half, down 17% in the month of December when we hit those lows. I mean, it just felt so overdone. That's why the 26th show, I was like, I think we're oversold. I think we're due for a bounce. And I think when we do get that bounce, it's going to be an incredible bounce. And I said, I think we could have a 1,000-point Dow update within the next couple of days. We ended up having it that day. So we had the, rip your face off rally to at least the people who were late to the party shorting stocks. And obviously, we had the relief rally, dead cat bounce, call it whatever you want. But it was an incredible rally. And then it was followed and a little bit of, pressure the next day. But, the buyers came back in. So the short-term bottom is in. Obviously, when we look at the S&Ps, and now we're trading still, over, 100 points above where we were just 3-4 days ago. But when you really put it in perspective, on a lot of these individual charts, it looks like just a blip. It looks like just a bounce. It doesn't look like a significant rally at all.
Like where?
So, and that's what we want to do this morning is kind of break it down. Let's look under the top 10 components just from the last month to get, Spencer Israel filled back in because he was off. A lot of our traders may have been off through the holidays here. So it's always good. And even for myself, it's a good exercise to look under the hood, to look at the top components and see what does the individual charts look like. And, what does this mean, we think from a technical perspective. So let's do that.
When you do this, are you looking at a daily chart or like a 5-day?
Yeah, I like to look at the 90-day, really. That's kind of my favorite, is to look at the 90-day. Give you, that's what I always start with. When I first look at the markets, even in the morning, sometimes I'll even look at the 90-day chart just to get a refresher, especially when you're off for 2-3 days. Get a refresher of kind of what we've done, where we've been, where we're coming from, and it gives you a pretty good feel. So if you bring that up, which you have right now, you can see on the S&P, you can see, we had the significant sell. We know December was awful. Went from 280 on the SPY, if you wanted to use SPY, and then obviously all the way down to well, if you're looking at S&Ps here, went from 280 all the way down to 233, and I'm using SPY now, and then back up to 250. So 260 would have been like a real gift. That's where you had we had the October low, the one cut low in December. That's where kind of the 50% retracement of the move is. I would love to see a bounce going back to 260. I don't think you're going to get there. Maybe you do, maybe there's still some buyers below. And I think you're still going to be in a trading range here for now because we've had such a wicked bounce. You'll probably have buyers coming in. If you get down in the lower 240s, you probably have sellers if you get up in the 250s and 255, 260. But I think there's a lot of overhead supply here. I think there's still a lot of things to worry about here. And I don't think the worst is over.
All right, let's start with the top component. This is as of the end of 2018, and that is Microsoft, MSFT.
That says so much about these markets.
Yeah.
Like when you see that Microsoft is now the most valuable company in the world. And it wasn't because Microsoft was just kicking butt and taking names. It's because they just didn't go down as much as the other ones. So when we've been talking about the resilience of Microsoft, 115, basically the high of the move, 101, so you're only off 10%, where you got stocks like Apple off 35%. You got stocks like Amazon trading down over 30% here. So it wasn't so much that Microsoft has been just a great stock. It's that it hasn't been as much of a dog as the other ones. But still, when you look at the Microsoft chart, this looks totally like a bounce to sell. It looks like we went from 110 down to 94. We got overdone and we bounced, and we almost got a 50% bounce of the recent move here. So if we just take, from the, those three highs at around 111 and go down to the low of 93, quick math on that. We usually have Joel for this because he's good with the math, but it looks like 18 points. Take, 9 of that and brings you up into this whole 102, 103 area, which is exactly where we got to back a couple days ago. So this looks like a typical bounce to sell. So, and here we are, we're down this morning, but, first component does not look good to me. And that's, making me a little more nervous about the market. Let's go on to the next one.
Number 2 is Apple.
And Apple, we know, has been just an awful, obviously a huge down move here for Apple. It's been basically the leader on the downside. We know Citi came out last week, or I think it was actually even on Monday, and cutting guidance, or at least for iPhone shipments. I've got it in my long-term portfolio. Yes, it is cheap on a valuation basis, but yes, there's a lot of things to worry about here. Didn't rally as much as some of the other ones well, actually, I guess you could say it rallied pretty good. We had up over $10 from the lows. But really, when you put this in perspective, Microsoft retraced almost 50% of its losses from December. This did not. And obviously, this was one of the leaders on the downside in November as well. So unlike some stocks that came back a lot in late November, early December, this one really did not participate. So it was starting from a lower base, and obviously a lot lower here now. So stock 220 back in October. Remember that day where we saw that crazy buyer. I don't remember when we were talking about it. I was talking about the after hours, and somebody was just buying Apple nonstop after hours that one day. They bought like millions of shares up to
That was
220.
That was like 2 months. That was like 2 months ago, I think.
Yeah, it was like back in October. Man, they lost a lot of money. Whoever that buyer was, I don't know if they were covering shorts or what they were doing, but they were just buying Apple nonstop, like 218, 220. And we could just tell by the trading action after hours it was the same buyer. It was because the market was way down that night and they were buying Apple up on the day. I was like, what is this person doing? Anyways, they obviously knew nothing about what they were doing. You know, if they were a short-term trader, they ended up losing the next day because Apple, I believe, dropped 5 points. If they were a long-term trader, they really lost a lot of money with all those buys of Apple because it's down 30% from that point in time. Long-term, you know, can you go wrong buying Apple 154, 155? I think you'd be okay long-term retirement account style. Short-term trend is not your friend. You're going to have resistance in the 160 area, which is where, you know, it's starting to, you know, stall out here. 159, 36, 158, 52, the highest in the last couple of trading sessions. So I think, you know, if you're trying to say this is the bottom at Apple, I don't think it is.
What about number 3 on the list? Mr. Amazon here.
Nice bounce. We've had a nice bounce in Amazon. And this is why you've got to, you know, put it in perspective as well, because people are, you know, you see people on CNBC, oh, these stocks are cheap here now. If you're buying here, you're buying somebody else's profit. This was $1,300 3 days ago, 4 trading sessions ago. It got up to $1,500. It rallied 200 points in 3 days. That's the rally to sell. 14 cents, in my opinion, that's the rally to sell. 1471, we're down 30 points here this morning. It's holding up a little bit better than the Qs overall. Qs are down 2.23%. Amazon is trading down here only 2%. But let's look, 1,700 down to 1,300, back to 1,500. That's a 50% retracement. That's textbook selling points. So I'll say that 1,500, the high from the last couple of days, 1,520, 1,513, is going to come in as major resistance here now. So I think I'm a seller of rallies in Amazon too. Not looking good so far.
And what about number 4, Berkshire Hathaway?
Berk B, obviously more defensive, more value oriented, but what a rally. This rallied better than anything, any of the other ones. I mean, we got down $186 on Christmas Eve, 187. We opened, or somehow got down, and the next day we were down $186. That's a day after Christmas. We've ripped up to 204. That's crazy rally. Again, that's 50% retracement of the move. That looks like a sell rally trade right there too. I know it's like a really, you know, steep chart, but man, getting back 20 points, we got back more than what the overall market got back on this. So if I was on Berk, I'd be ringing the register. Sorry, Warren.
What about the one that started it all really here, Johnson?
I wish we would have did this show on Monday because obviously we're sold off a little bit on all these. Like I'm looking at all these charts and they all look like sell-offs. But now you're 201, you're already kind of getting a little bit of sell-off, so you're kind of selling in the hole. But what I would say is if you can get anywhere, maybe we get a little bounce here this morning, maybe get anywhere near 204, 205, you know, on some bounce. I'm a seller of those bounces.
The one that really put the sell-off here into overdrive in December was Johnson & Johnson. So let's talk about that one next.
Yeah, and it's got its own problems. It's been a nice bounce back for J&J as well. Obviously, you know, the talcum powder issues here where the driver and the stock lost that 10% that one day. Never really recovered and obviously continued to slide down. We were saying we thought it could get down to 120 when the stock was 130. It almost did that, getting down to 121. It's bounced back up. You get back up to the area where, you know, the lows from that day were the 130, 131. I think you got overhead supply here too. Like, I hate to be the bearer of bad news. And obviously it looks, you know, like, you know, when you're down 1.5%, I'm just kind of calling what the market's doing. But I think if we did the show on Monday, we'd been saying the same thing. That just looks like, you know, that when you see stock charts lose so much and then they bounce back 40, 50%, that is typically the spot where you lighten up and get out. They don't usually get it all back. And why? Because there's so many people caught long. And there's still a lot of people caught long on this. This isn't just going to come back to 140, 145, because there's a lot of people burned. Anybody who bought this September, October, November are all just praying, you know, here they are trying to play defense in November and saying, okay, I'm going to hold Johnson & Johnson, I'll be okay. Well, they weren't okay. And we were warning about that these stocks wouldn't, you know, necessarily be okay if they start selling the market hard, that they would start selling everything. And they did that. Johnson & Johnson had a catalyst that really kickstarted it. But you look at this and you think the same thing. I mean, you got a 50, you know, you don't have quite a 50% bounce back on this, but like on that Berk chart, you definitely have a 50%, you know, over 50% bounce back. So I don't know. I think it was solid rallies on all these, and we've had the rally. So now you think, okay, well, if you get a little bit of a rally today somehow back to where we were maybe, a couple days ago, or back to where we were on Monday, I think you're gonna have people willing to like hit the bid. So I don't like the chart of this either.
Well, what about Goog? And these charts all kind of look the same to me.
And that's what we were saying too on the pre-market show, is when you have volatile markets, when you have the VIX spiking, correlations all come together. It doesn't matter what the stock is. I mean, you can look at Coca-Cola, you can look at McDonald's, you can look at Amazon. All those charts look the same now because all stocks are just moving together. A stock is a stock right now, and people don't either want to own stocks or they don't want to own stocks. And that's why everything is moving together. You'll start to see separation when the VIX comes back in. But with the VIX up here at 27, 28, the stocks all start moving together. They all become correlated. We've seen this in the financial crisis, it was the same thing. And that's why when people were hiding out at the beginning of December and some of the defensive issues like Coke and Pepsi, we've warned multiple times that if it really starts to get ugly, that those will not be safe to hide in. And that's what's happened. Now they've come back though, so you look at Google, it's tech stock, obviously. It's come back. Value, is there value here? Sure there is. If you're a long-term investor, like I said, back, a few days ago, I said I'd be nibbling. Now, if you're coming and you're nibbling now, though, you're a little late to the party. We just rallied $50 in Google. So we just rallied 5-6% a week. Are we going to retest those lows? I think so. I think you'll get a shot again at those lows. I own Google in my long-term investment portfolio. I'm not selling it. I believe in the company. I still believe Google is going to be, and it has been a couple times, but it's kind of given it up. I think Google eventually is the most valuable company in the world. They're just smart. They're doing so many different things. There's so many irons on the fire. Obviously the search engine is, they're the cash cow, but they have so many other things they're cooking too. I'm a big fan of Google long-term, and the stock is not really that expensive, but I think you can get a shot back under 1,000 on this again.
New year, new Facebook? Question mark.
I own Facebook. Wish I didn't. I'm in I'm in multiple times, but I think I'm averaging around 143, 144, which is not good. I don't know what to say. It's down here again. This chart does not look good either. So, and this is one that I almost feel like I'm down like 6-7%, and I almost feel like cutting a loss on it. So, and I know that's not obviously always something that investors like to do from a long-term perspective. I have it in the long-term retirement account. The chart is just awful looking though, and it's cheap. From a valuation perspective, it's very cheap. It's just a matter of can they continue to keep the traffic that they currently have or grow that traffic. I don't know. It's always that risk that something better comes out. Facebook, everybody's on there already. I don't know where the growth comes from. Yes, they have some other things that they're cooking up, but growth is slowing, and that's concerning. Valuation is attractive here because it's not really expensive anymore comparatively to where it was, but there's problems here for Facebook. So, unlike Google, which I'm a huge believer in long term, I don't know if I'm as big of a believer in the Facebook story. So, and that's why I'm somewhat concerned on my Facebook position, not concerned at all in my long-term Google position. As a trend is not your friend here again. All kinds of resistance, especially probably near, the couple highs from a couple days ago, 134, 135, multiple highs in that area. Get above there and you have all kinds of highs in the mid-140s. Just all kinds of overhead supply here. Everybody's crushed on it. I think the path of least resistance continues to be lower.
I'm not going to delete my Facebook, but I feel a lot better having deleted the app from my phone, knowing that.
I have the app on my phone, and I never go on Facebook. I'm a Twitter guy, though, but I never go on Facebook.
I removed the app, and normally, you go on a big vacation like the one I just went on, and you're posting your pictures to Facebook as you go, and I'm not even on. I don't have it on my phone anymore, so I can't do that, and it felt very liberating to not have that. So removing the app, I think, took away most of the annoyance of Facebook for me. Last one on our list here, Exxon Mobil, XOM.
Obviously cheap, obviously best of breed. If you want to own an oil stock, 4.87%. If you want to own an oil stock, we'll start the conversation if. This is the best of breed. This is one that's going to bounce back. This is one that's not going to go bankrupt. I mean, you get in these smaller oil companies, oil's down to $45, it goes into the 30s, you could start losing some companies. Exxon Mobil, I believe, is safe. Exxon Mobil, I believe, is best of breed. That being said, if oil continues to go lower, the stock will continue to go lower. So, and right now it's a stock, and all stocks are trading together, even the oil stocks. Here's oil. Get market gets a bounce, oil gets a bounce. Market sells off, oil sells off. All kind of moving together to a certain extent too. I am just I lighten up my energy exposure on the recent rally the last few days. I took some losses because I didn't have any Exxon Mobil, but I had some Canadian ETFs that were loaded up with oil stocks. It's been awful for them. I took some of those losses because I had a pretty good year where my investing year, where I took some gains. We know I talked about I took some gains in Merck. I took some gains in Abbott Labs. These were long-term gains. I took some long-term gains in MasterCard. I took some big gains because I've been nervous about the market. So I offset a little bit of it with some of these losses that I had from the last couple of months in some of these energy ETFs. Oil's awful, looks awful. Exxon Mobil is okay. I mean, 65. I've owned it a couple times down from the 60s, and I've been happy I have. I'm just concerned that oil is continuing to go lower here. So where can this go? Who knows? Technically speaking, you got a low to lean on. 66.55, the low from 2015. Interesting enough, we got down to 64.65, so just a couple bucks lower than that on the recent swoon. So you kind of have, support here in the 65 area. So there is that potential where 65 could be the bottom of ExxonMobil. It has a nice dividend. If oil stops going down, you'll be okay. But I don't know if oil is going to stop going down or not. I'm not a believer that, we're going back to $60 oil anytime soon. I think we can get the oil in the 30s easier than we can get oil in the 50s here now. So that's the only thing concerning about ExxonMobil, but and the chart itself from the last couple of months doesn't look good either. But down there 65, maybe get down another shot down there, maybe you take a shot.
Question from the chat here, Dennis. Can you repeat your ideas from about a week ago when you discussed individual traders making money manually versus the algos? I was not there, obviously. So
we'll take off our investing hat for a minute, and I know if you look at me, I have a lion's hat on, but pretend this was an investing hat on, and we'll put on our trading hat now. So let's talk, day trading here. Let's talk, how I trade. And I do a lot of index arbitrage. I do a lot of statistical arbitrage. I do have some algorithms helping me out a bit, but I use less algorithmic trading now than I did 10 years ago. And why is that? Because most of the really micro inefficiencies, the really fast stuff is gone. I mean, you see that, that it's, non-existent here for the human trader, because obviously high frequency traders will pick off all the free money. They're faster, you're not going to beat them. But that being said, the pre-market after hours, it's not as efficient as it is during the regular session. You have a lot of high frequency trading machines that don't even trade pre-market. There is some. Don't kid yourself. There's a lot of the majority of your volume in the pre-market after hours is going to be high frequency traders as well. But a lot of them, if they're doing straight up index arb, they can't buy the 500 stocks or sell the 500 stocks as easily if they're doing it against the S&P, because 300 of them don't have a market at all. So it's a little bit of guesswork in it. So that's why as a human trader, we often like to look under the hood and we say, hey, if you get the top 10, 15, 20 components, you're getting a pretty good feel for what the index is doing. That was the exercise we just went through. So, on a longer term basis, we went through it. But algo trading is here to stay. It's not going anywhere. Yes, you have people coming out and saying, oh, we need to get the algos. We need to get them before they kill the market. I don't believe for a second that this is the algos, that this recent sell-off was because of the algos. People who are saying that, I believe, don't know what they're talking about. That's my opinion. Yes, algorithmic trading increases, volatility. It can increase volatility during times of stress because the liquidity is reduced. But this has been there for years. I mean, we've had algorithmic market makers for 20 years. This isn't something that just came out miraculously. The algorithmic market making, our firm was doing it 20 years ago. So to a certain extent. So this isn't something that's just new birth. But, we do know during times of stress that, there isn't the affirmative obligations that the old market makers had. So, yeah, you can see liquidity vanish. Yes, you can see those moves a little more extreme. But, to say, the financial crisis was caused by algorithmic trading, or, the recent sell-off was caused by algorithmic trading, I don't believe that for a second. Algorithmic trading, can, obviously exacerbate moves during times of stress, but there's still, where the stocks are going to go. Like I had, one friend that said, where the stock wants to go is still where it's going to go, despite, if it's getting whipsawed around a little bit. I think, the financial crisis was caused by, obviously, housing bubble burst. And a lot of, banks, and, then, obviously, it blew up into everything else. But, that's where it started. This was caused by the market just being over exuberant from, to borrow from Alan Greenspan. We were going straight up for too many years. We needed to have a correction. The valuations were getting ridiculous. NVIDIA going from 100 to 300. It was just over exuberant. They needed to correct. They needed to correct to realize, and they really did. And that's why we saw the value portfolios outperform in the last, quarter here. Stocks like Merck and Lilly, have held up very well. Stocks like, Coca-Cola, we know have held up well. Where you've got stocks that, have P's of 80 or 100 have come in hard. And that's just the natural corrections of the market. Is this just a correction, though, now, is the question. And that's what we don't know here yet. It's still to be determined. There's a lot of things to worry about. But, I don't blame the algos for any of this. I think you have to be aware, that the algos trade differently. And yes, they give you opportunities as human traders because they overshoot and undershoot. We know in these headlines, you get algorithmic traders that are trading just the headlines. Sometimes the devil's in the details and they read it wrong. You see a stock rally hard on its initial headline numbers. And then what happens 5 minutes later, it's selling off. Why? Because you've got human interpretation there that's saying, hey, this isn't as good as it looks. And you've got those institutional money managers coming in and maybe selling into those rallies where the algos just read the headline and read it wrong. So don't think that all the algorithmic traders are just informed and they know everything that's going on. A lot of them make mistakes as well. And sometimes as a human trader, you can profit from those mistakes. So I still think there's very much a place for human day traders, and I'm, a testament to that because I've been, trading basically for the most part 90%, manually here for the last year. And I had one of my best years ever last year trading. So there's still very much a place for traders and day traders and swing traders in this market. And I think, you just got to be aware, of algorithmic trading. Yes, it's harder to hit the bid because they move the bid so fast. Yes, it's harder to lift the offer. Yes, it would maybe be easier if it wasn't any algorithmic trading, but it's here to stay. It's not going anywhere. So we have to learn to adjust. And that's what, I've tried to do. And that's what a lot of traders at Bright Trading have tried to do. And a lot of them doing it successfully.
And we will be discussing liquidity a little bit with our upcoming guest, Steve Sears, 835, specifically in the S&P futures. But Dennis, while you were talking, I just remembered something. I can't believe I forgot to tell you about it, but it happened so long ago that it slipped my mind. It happened the Friday before I went on my trip. And I was going to tell you, and then I just didn't, and I forgot. But I'm going to tell you now. I drove a Tesla Model 3.
Awesome.
And yeah, it was really cool. And I was going to call you guys right after just to tell you that I did it.
What was your thoughts?
It was so cool, man. It was so cool. They had a whole giant touchscreen that there's no dashboard or anything. It's just all on the screen in the middle there. There's a ton of information. I didn't really know how to use it all, honestly. But it was a very smooth drive. And so I can understand the hype. After driving in one of those things, like I'm not going to go out and buy Tesla, obviously, or buy the stock, but I can understand the hype after driving one of those machines. It was really, really cool. Really, really cool.
I'm a fan of the stock, and I've sold all my Ford. I don't have GM. I never did, but I had a lot of Ford stock. I took the loss last year. I've said, for some reason I can't stomach this one in my portfolio, but I think the stock can go higher. Now you see it bounce back hard on the rallies, and it held up very well, really. And obviously it got under $300, and yeah, so you can say maybe it got hit with the overall market, but that's the kind of stock that I think you want to own on pullbacks here. I believe in the Tesla story. Valuations never, always been a little bit scary, but it's getting more attractive. If they're going to stay cash flow positive here now and start making money, I mean, that's, interesting in itself as well. The one wild card is if the overall market really goes south, the stock's obviously going to get dragged down with it. But if the market can stabilize, let's just say hypothetically, the market, at the end of 2019 is where it is today. We don't go down. Maybe we go down early, we come back all the way. I think Tesla is a lot higher in that scenario. So I think Tesla outperforms the overall market. But, obviously if the market goes south, Tesla's going to get dragged down with it. And Tesla has a high beta as well, too. So if the market, tanks and we lose 500 more S&P points here, Tesla's probably going to be down in the 270, 280 area. There's nothing you can do about it. So the only reason, I don't buy Tesla here is probably because I'm very nervous about the overall market. But on a relative stock basis, Tesla's held up well. And I believe in the story. So, Jason Raznick has obviously been, who has obviously been on our show multiple times and given very good arguments on the bullish story. The cars are awesome looking. The cars are really cool. I've sat in them too at Somerset Mall. And I think it's, I don't remember the two that I sat in there, but amazing cars. I think there's going to be, once they're on the road, like Jason Raznick, once you see more of them, there's going to be more demand for these things. So, I believe in Elon Musk as well, although, the wild card like Gene Munster says with him is we don't know what he's going to say. So the biggest risk case that Gene Munster says to Tesla is Elon Musk himself because you never know what he's going to say. But I like Tesla as a stock, and I think from a relative basis here, I'd be a buyer on Pomax.
Yeah, the one thing I really was not used to in the car was the regenerative braking. So if you take your foot off the gas to save energy, the car will brake for you if you take your foot off the gas. And I like to coast a lot, so that
well, there's the auto driving function too that Joel was talking about on the show too, which is just
that
awesome.
you have to subscribe to that. That's like a subscription service that they make you pay for, or so the driver was telling the owner of the car was telling me. But like it's like a subscription. You basically like the tech is really cool, and there was a ton of information on that screen there, and just the way the car is built is cool. But it is 8:31. So can we get some imbalances, Dennis?
Get some imbalances. The S&Ps are falling out a bit further. So from our little when we started a little rant there, we've lost about 6-7 S&P points here just since we started the show at 8 o'clock. They're small to the south side, obviously, today. Bank of America, 273,000 to sell. It's probably the one that jumps out the most. Unbelievably small of these imbalances. Okay. And that's probably, again, institutions are like, I'm not showing that I got $1 million to sell or I got 100,000 to sell here at the open. I'm going to hold that order till the very last second. So that's why you're not really seeing much from imbalance land. I would say it's not a driver here this morning at all. Biggest one, Bank of America, 273,000 to sell. Banks are getting hit here. We do have the TLT trading higher here this morning a little bit, but it doesn't even matter. When the S&Ps are down 1.74%, the banks are going to get crushed, and that's what we're seeing.
Speaking of banks, Wells Fargo is catching an upgrade this morning from RBC Capital to neutral, or they're neutral, sector perform. But is Wells Fargo just trading the same as all the banks?
Yeah, it doesn't matter. I mean, RBC is not influential. No offense to RBC there. They can move stocks a little bit, but typically when you get an upgrade or a downgrade on bank stock, it's not worth much anyways. Bank talk and another bank. But Wells Fargo is trading down 1.4%. So upgraded, doesn't matter. Market's getting hit. So if this market was flat, Wells Fargo would be trading higher. Probably would be relatively strong relative to the other ones. I mean, Bank of America's down 2.5%. JP Morgan's down 2%. Citigroup's down almost 3%. So Wells Fargo's, only down 1.4%. So holding up better than the other ones. But again, when the market's down, sinking tide sinks all ships. We'll say it backwards. Rising tide rises or raises all ships. Sinking tide, I guess, sinks all ships.
Sinking tide
it's a
sinks all ships. Okay.
I was looking, at the pre-market here. I'm looking at basically the S&P 500. I'm scrambling to find any green stock. Procter & Gamble, Coke, they're all red. So here's your defensive stocks. They're trading in the red. Like we said, everything's moving together here now with the VIX up over 27 or 28. This is selling across the board here. There's, the only thing I see trading higher, a few gold stocks, gold trading higher. But did you even see like last week? So gold continues to trade higher, but some of these individual gold stocks aren't really performing as well. Well, they're holding out, but they're not really taking off. So let's just put this in perspective. Gold, we're going a little tangent here for a minute before Steve comes on here. Yeah, GLD, and rally basically from 116 to 121. Very good month for gold in December. Silver as well. Silver has been blasting off here from 1350 to 1450. It's a good month. You look at the individual miners like the GDX. Okay, well, yeah, it's up, but we went from 20 to 21. I guess that's okay. But you can start looking, at Gold Corp GG. Well, it started the month at like 950. It's like 980. I guess it's a 3-4% rally. Agnico Eagle Mines, I guess it did okay. I guess it's there. It's just they've been such dogs. It's really, like Newmont Mining went from 33.5 to 34.5, and they really haven't really outperformed that much. Like they're outperformed, but it's not like, oh wow, look at the rally in gold stocks. No stock is rallying in the month of December really significantly.
All right, 8:34 here. We're going to take a quick break and grab our guest for the day, Steve Sears, formerly longtime Barron's columnist, now the chief market strategist at Stratify. So we'll be right back in a moment with Steve. All right, and as promised, we are live with Steve Sears, Chief Market Strategist at Stratify, former Barron's columnist, author of The Indomitable Investor, Why a Few Succeed in the Stock Market When Everyone Else Fails. Steve, Happy New Year. How is 2019 treating you so far?
So far, so good, but it looks like Mr. Market's got some tricks up his sleeve for us.
Yeah, and I want to ask you about that, but let's start off with this column that I read of yours from a few days ago in Barron's. You're talking about with the VIX spiking, it's time to revive the chaos trade. Explain a little bit about what you're saying in that column.
In the past, prior to February of 2018, when the VIX spiked 115% in one day, and the S&P 500 went down 4%, there was a perpetual demand for upside VIX calls. And so you would have many institutions and hedge funds would continually just buy VIX 20 calls. They did this even though the VIX was at like 10, 11, 12, 13. Why? Because they reasoned that the VIX calls were very inexpensive. And if something happened in the stock market to spook investors and stocks went down, you would make money as the VIX increased. That trade's been very much out of favor due to some concerns about how the VIX market functions. However, we're back in a situation in which it makes sense to revive that trade, and we're seeing the beginning of that now around this coming Fed meeting. People are buying these upside VIX calls. It's no longer a VIX 20 call, which was historically the big contract. It's VIX 30 calls, it's VIX 40 calls. And the principle of the past applies today. They're inexpensive, they're sticky, which is to say that if the market goes down, you should see a lift in their value. And chaos should define this coming trading year, which is, I realize is a bold thing to say. Yep.
It's just Dennis Dick here, and you know, obviously when the market starts going down, we know the VIX is going to rise here. Fear comes in, and obviously volatility is going to rise as well. But isn't this usually short-lived though? Like we often, you know, the VIX, you know, has these spikes, and we've seen it, you know, over the last decade. I mean, financial crisis got up to 90, it got crazy. But it seems like, you know, eventually the markets do calm, whether it's going to be at a lot lower price or not. Eventually it does calm down, and eventually, you know, it seems like the VIX comes back down to under 20, or, you know, obviously we're trading under 10 here at one point in time a year ago. Aren't these trades usually short-lived?
They are. By no means am I suggesting that we're going into like a VIX regime of 60. But what I'm talking about is being positioned to play these sort of short-lived volnados. And that's basically how it is. You have to be very disciplined. These aren't set and forget trades.
Yeah.
You're basically going to be putting these things on. I'm not going to say that they're the Wall Street equivalent of scratchy lottery tickets, but they can be. And look, Doug, the underpinning of the market has changed dramatically. If the realized volatility of the S&P 500 was about 6.3% at the end of 17, at the end of 18, the realized vol for the S&P 500 is about 16.8. I frankly don't see the realized vol going down anytime soon. So I think you're going to see the vol is going to be a lot higher, at least for the first quarter. And the futures look like we're going to have a pretty bad opening today.
Yeah, I think I agree with you. The volatility is here to stay, at least in the short term. So I think you made a good point just saying this is not, you know, to sit and forget, like throwing these long-term, buying these things, you know, a year out here, I think could be a losing trade. But I think you're right. I think in the short term, VIX, you know, could continue to spike, or VIX is going to stay elevated for a long period of time. So there is some money to be made in the short term, maybe trading this stuff.
Well, look, that's the key. And thanks for giving me that opportunity to clarify that. I'm not saying go out and buy a VIX call that expires in a year. We're talking about trading 1 to 2 months out. We're talking about babysitting position in real time. And when these things happen, and if you see any movement in the value of the contract, you've got to be ready to trade. If you can make 100% return, you do it. If you take 50%, do it.
Steve, you also talk about a Goldman Sachs analysis that determined that liquidity is lower in the S&P 500 index futures. I'm wondering what effect you think that's having on the rest of the equities market.
I think it's having an impressive effect on the equities market because it's the S&P 500 futures market that determines largely the prices in the stock market. And Dennis can speak to this as well. Most everybody's got one eye on the S&P 500 futures and another eye on stocks. And what happens in the futures market tends to lead what happens in the stock market. So if people are not willing to make markets in size or trade in size in the S&P 500 futures market, it ripples all the way down into the stock market. Now, if you were to just take a look at your own trading and investing, it's pretty hard to go in there and get a great fill on even 500 shares or five contracts in the options market. They're going to break them up. And I think that reflects the lack of liquidity in the futures market and elsewhere.
And there's a point I haven't made on this show in a long time, but a lot of people say, algorithmic trading and it's high frequency traders that have obviously reduced liquidity here in these times. And yes, high frequency traders back off liquidity, but something that you just were starting to mention, I think, I just want to get your thoughts on this as well. I've mentioned this multiple times, is that I think a lot of our reduced liquidity isn't actually from high frequency algorithms. It's because all of your institutions are using algorithms now. They don't have big orders sitting on the book anymore to be, like basically if you go back to like the 90s, and obviously I've traded for a lot of years because I can date myself back to the 90s, you had big institutional orders on the book all over the place. They weren't breaking up their orders into smaller orders. So when you had a huge seller come to the market, there would be another big order out there to basically, take in. And so if you had somebody come and sell 500,000, they don't have to go so far down to find another order that would actually be able to take that 500,000 hit. And so the market isn't going to drop as quickly because there was big orders on the book. Now with institutions breaking up, there's still slow liquidity drift into the market, but with no big orders on the book, if you have a sudden liquidity demand, a VWAP order isn't going to be able to bring in that supply as well as a big order just sitting out there. So I think because institutions use so many more algorithmic orders now, I think there's less liquidity because the institutions aren't sitting on the books. What are your thoughts?
No, I think that's exactly right. And everybody that I speak to at the big banks reveals that it's basically crickets on the trading floor. The hedge funds, which are just closed out one of their worst years in ages, are not trading. And depending on which bank you go to, they say that they've been out of the market more or less since February when the VIX spiked, or they just basically winnowed their trading volumes down throughout the year. And that has a massive effect because if you don't have a ready-made source of liquidity and you have to go work the order yourself and create it, people don't trade at great prices. It's not like Amazon.com where you can click the button and get what you want.
All right, so Steve, it is obviously the first trading day of 2019. We mentioned we're off to a slow start here this morning, but give us your overall sense of sort of where we're heading. Further on out into the year. Not asking for any specific hard predictions, but just for a general sense, at least in the U.S. equities markets, are we due for a continued bounce here, or what?
Well, I'll tell you. When I was still with Barron's, and I'm back on the weekends writing as a columnist, I said that at the end of 2017, I said that volatility was perhaps the world's most attractively priced asset class, and it turned out to be just that. And I think that now it's no longer the world's most attractively priced asset, but that vol is back, and that volatility is back, and that we're going to see tons of it this year. It's really hard to predict. Do we end lower or do we end higher on the year? But I think that all these forces of globalization and economic growth off of low rates are going to readjust as rates rise. And it's going to create an enormous amount of opportunity for investors with the time and resources to engage in what I call kind of time arbitrage, which is you can pick these good stocks that pay dividends that have solid thematics, and you can buy them at good prices, lower prices. And aside from that, every morning now I find myself checking Twitter to see, if the president has tweeted something out. And I don't mean that to be political, but if you've been in the market long enough, you know that this sector or that stock or even the broad market responds in certain ways to certain information releases, to corporate earnings, to economic data. But now sometimes the market has a different flavor and a different tenor that I've not seen before. And I think that's something that concerns me personally and professionally. And I think the world's I think we're in for a rocky year.
So you don't think the lows from, just Christmas, we call them the Christmas Eve lows if you want, because we've rallied over, 1,200 Dow points from that point in time, although we're going to get back, it looks like a third of it this morning. You don't think those lows are in then? The lows from the middle?
No.
All right.
I mean, it's not my style to sort of to predict, like, we'll go down, X points or do this.
Yeah.
I think it's extremely whippy and extremely volatile, and I don't think the lows are in because I think the underlying conditions remain unresolved. You have to worry about tariffs and China's economic growth. There's going to be the Fed is normalizing rates. And I remember as a kid, going back in the 90s, when I was first learning about options in the markets, and one of the old guys told me, he's probably younger than me than I am today. He says, "Look, kid, it's all about the CFC." I said, "Huh?" He says, "The cost of capital." He says, "When money's cheap, just do whatever. It doesn't really matter. The risk is basically not doing anything. But when the cost of your capital is higher, you have to be more circumspect." And I think I think that remains the critical, if not one of the controlling facts. And I think how that dial has changed for individual investors, institutional investors, means that the bottom is not in. Bottom line.
All right, that's a nice jovial way to end this interview. So thanks. Steve Sears is the chief market strategist at Stratify, a weekend columnist at Barron's, author of The Indomitable Investor: Why a Few Succeed in the Stock Market When Everyone Else Fails. Steve, as always, thanks for the time, and we'll talk to you again later on in the year.
All right, guys. Take care. Thank you.
All right. Thanks, Steve.
All right, Dennis. Well,
I gotta tell you, I couldn't have set on the worst possible time. I like Tesla long term.
Yeah.
I got those words out of my mouth that they come out and they warn.
Yeah,
bring it up. Bring up Tesla. What was this headline here? Because obviously we went to the interview with Steve. I'm watching Tesla in the background. I was like, glad I didn't put that in my long term portfolio there 5 minutes ago. But Tesla falls as Model 3 deliveries look like they're going to miss estimates here. So I've got about a dozen headlines that just broke here just after 8:30 on Tesla.
Here's what the headline was. Yeah, well, the two main headlines of that bunch. One was they came out with their Q4 and 2018 delivery numbers. Q4, they delivered about 90,000 vehicles, which I believe was lower than estimates or lower than they had previously guided. And they also announced a $2,000 price reduction for the Model S, X, and 3 in the U.S. this year. So those are the two headlines I think people are keying in on as Tesla is getting rocked here this morning.
Yeah, getting rocked down 7%, 6.5 now. I'd look at those two lows from the 294, 295 and see if they're safe. I still like the Tesla story long term. This didn't change my opinion that I just gave. I'm a believer in the story long term here now, and I don't think it's as much of a people have been saying this thing's going to go bankrupt. I don't think that's happening. So I like it long term. I like the cars; they're cool. You said you just drove in one. Short term here, this isn't good for the stock. So I think you could retest those lows of the move. Are we going to bounce right back here? It's going to whip around. We're down $20 here, but obviously I'm still concerned on the overall market here as well. So there's not much working in Tesla's favor, at least for this morning.
Yeah, bad news on a down day is I imagine
gets hit twice as hard.
Exactly.
I mean, we're already down. It was already down coming in here. We're trading the 325 area. Now you come out with bad news. I mean, they're going to hit you twice as hard. So I wouldn't be surprised if it tested 300 here today.
300. Oh well, we're only at 311 here. So
yeah,
that's
not
very far. So. Okay, yeah. I was going to say $300, but we've already fallen.
Yeah, 332 close. Looks like 311. So we just had 306 there on that last swoon. So we'll see. not good for Tesla here in the short term, at least. That's that makes my market timing, make it obviously horrible, talking bullish here 5 minutes before it happened. But I wasn't talking bullish. I had my long-term hat on when we were talking there. So you're not defending it. But, obviously, if you're buying it from 325 down to 310, it's not good news if they come out bad news here. So I think you're going to get cheaper. I think the overall market continues to bring it down. But I do like the story long-term.
What do you think about what Steve was saying about the lack of liquidity or the lower liquidity in the S&P?
100%. I mean, that's just the market we're in. Every market maker, and we've talked about this, the last week and a half when you've been off, I've been asked this question a few times. I mean, market makers always back off during times of stress. They have to. You can't be picking up nickels right now when you're losing dollars. So they've got to back the quotes off. But if you look on anything outside of like the big, 20 components of the S&P, liquidity gets very thin. You get outside the S&P, it gets very, very thin, especially in the first few opening minutes of trade. Sometimes you're seeing stocks 20, 30, 50 cents wide in spreads. And that's because they've got to protect themselves. I mean, market makers need to keep flipping in and flipping out. And if you're buying the thing going for a nickel and then all of a sudden it goes down 50 cents on you, it's a good way to lose money in a hurry. So they've got to be very careful with how much liquidity. So always at times of stress and the VIX goes up, liquidity is going to be a lot lower. I still think, and it sounded like Steve agreed with me, is a lot of this, and people don't like to blame the institutions. And I'm not blaming the institutions either. I'm just saying they do the orders differently. There isn't big orders sitting on the book anymore. There isn't, Fidelity doesn't throw out a 1 million share order there and let it sit there. We know the odd time we go and we do see the odd institution do that, but, if we went back to the 90s, big orders all over the place. So if somebody wants to sell 1 million shares, they can get it done within 50 cents. Now you get somebody wants to sell 1 million shares in this market, it's going to really move it because the institutions aren't on the books to do it. And the high frequency market makers don't have any affirmative obligations either. Old days had a specialist system on the floor that they do at a price, sell 1 million. Okay, well, I'll put it together. They bring the other 4 traders together. They'd go one up, which means 100 shares on the bid, 100 shares on the offer, which means we're putting it together in order here right now. It's not going to trade. It wasn't automated markets then. So it'd be one up, and you knew the specialist was putting a big print together. So he's got a huge sell in the market and wants to dump a mill. And he's going to call over some other 4 traders, want to give me some help with this. I'm going to have to take this down about 3 points here right now to get this order done, or 2 points to get this order done. Other floor traders, locals, liquidity providers would come in and say, I'll take a piece of that too. Maybe one's got to do it down $1. There was all that, now if you throw 1 million shares to sell, it's done instantly at whatever's on the book. So it's this instantaneous execution that's scary as well. That's why institutions have had to change the way they trade, and they break their orders up into smaller orders so as to not show their footprints, to not show, if they got a big order there, because if they get sniffed out by, a high frequency trader or by, any, opportunistic trader, even any traders in our room. I mean, if you see a big seller in the market, our traders, are going to sell along with it. So, that's why, that's just, market efficiencies there. So, the market's changed very much. The way institutions do things are very different than 20 years ago. And it all adds up to less liquidity on the books. We don't notice it during times of 2016, 2017, because volatility is so low that high frequency liquidity is making up for it. But when the high frequency traders back off, you don't have much liquidity on the book at all. The majority of our market's liquidity now is provided by high frequency traders, and they back off during times of market stress. Back in 1995, you had lots of institutional liquidity helping out, and that's not the case anymore. So it's the dynamics of the market that have changed that, mean, we can have, these, periods where liquidity gets very low, a lot lower than it did 10 or 15 or 20 years ago.
All right, let's 5 minutes left in the show. Let's run through some notable ratings today. Obviously, in a down market, the ratings won't matter as much, but we still like to highlight the notable ones, or the ones that we find notable. We already covered one, Wells Fargo getting upgraded RBC this morning.
Yeah.
A couple others on my list. We have Estee Lauder getting upgraded at Citigroup to buy. Baxter International upgraded at Citigroup to buy.
Also upgrade at Morgan Stanley too, so the double upgrade for Baxter.
Okay. And Sirius XM, that one I was up last I checked, upgraded at JP Morgan to overweight here. And those were the
PHC, Bausch and Health Companies, the old BRX is upgraded at Piper. You had Abbott Labs. This was a big one on my list. Downgraded to sell at Citigroup. Hasn't traded this morning. It's down. I sold some of my Abbott Labs. I would love to have sold here in the last couple of days as well, but
yeah, downgrade. So as far as downgrades are concerned, we had Abbott Labs, we had Medtronic downgraded Citigroup, we had Aflac downgraded JP Morgan, I had one more on my list. Nope. I think that was it. Just Abbott Labs, Medtronic, and Aflac. And then no real initiations to note here on any of the ratings here this morning. Just Moderna initiated, Barclays, and Morgan Stanley. Respectively. Oh, Dennis is back. Here we go. Hold on 1 second. Dennis, are you with me? Let's see here. Hold on 1 second, folks. We lost Dennis, and we're grabbing him back. Dennis, whoa.
Yeah, I'm here. Skype dropped the call.
Oh, okay. Sorry about
We
that.
have a Skype issue here, so I don't know why.
That,
Microsoft. It is what it is. Skype dropped the call there just quickly.
Okay.
So we haven't had that happen in a while, but we did for a couple of technical hiccups. Can you hear me?
Yes, I can.
Okay, sorry about that. I don't even remember what I was saying, but Skype dropped the call. I was trying to call you back, and then it was trying to actually call Steve, I think. And
yeah. No, I got that. All right, I was wrong.
So I was saying Abbott Labs, I think.
Yes.
Hell of a rally here. I agree with this call. I sold half my position. I was contemplating selling it all. I'm in from Abbott Labs from 2011. I'm up a lot of money in it. This is in the long-term portfolio, but man, it's like $3 off its all-time high. I mean, this is the kind of stock that, I think if you, and obviously this is one of the better performers, so you can make the argument, the relative strength, you want to hold that. But if the market starts to go south, like I said, they're going to hit everything. And I think this is one that's come back a long ways. I think the recent rally is a gift here. So I might actually even lighten up more on my Abbott Labs, but not today if it's going to be down significantly with the sell downgrade.
All right, 8:57, Dennis, any final words of wisdom for us today?
Just volatility. Steve is absolutely correct. Volatility is here to stay, at least in the short term. I'm not playing it from, the VIX perspective. We know, like in my long-term portfolio and, in the short term, I like Virtu Financial as my VIX play because they're making money by trading. And when the VIX is up, I'm saying they're making a lot more money as well. The only wild card is if they start to talk HFT regulation, then that could potentially bring VIRT back down. I don't think that regulation is coming, but whenever, the market's going to turmoil, everybody starts blaming the bots. They automatically think, oh, let's regulate this. And you get some, people talking, and that can obviously be a concern here for VIRT. So that's the wild card with that trade. But other things being equal, I think they got to be kicking butt in this market. Like I said, December was one of my best months in years. So I'm assuming Virtu Financial having one of their best months in years as well in December. They make more money because spreads are wider and obviously inefficiencies are greater.
Any update on imbalances, or are they still small?
Still to the sell side, still small, 380,000 to sell in Bank America. Burke, 57,000 to sell. We already said Burke had such a rally there. I'm a seller of that rally, but it's going to sell off here this morning, so you'd hope for a bounce to try to sell into. I mean, this market is going to be volatile, and you just got to be aware that volatility is going to be here to stay. You're going to see the whipsaw days. I don't think we're going straight back down to the lows here. So I think if you're coming in here and selling us when we're down 400 or 500 points, I think you could potentially get another shot. But I do agree with Steve. I think the lows are not in. I do think we're going to retest those lows from the Christmas Eve lows, whatever it is. I think we could take it out as well. So I'm still not adding anything really to my long-term portfolio. I did add some FedEx there, just on the Christmas on 26th. I added a little bit of FedEx we talked about. I had a little piece of Western Digital, a half position, just to nibble. That's because Sean was on the show on Friday. I asked Sean a while ago about Western Digital when it was in the 40s, and Sean said, I like it, but I think we're going to get cheaper. Sean is now in, so I was like, Sean does a lot of. We're talking Sean Udall, and if you're listening, Sean, we'll give you a shout out there. He makes a lot of great calls long term and we know Sean's a little longer term trader, but he makes a lot of contrarian bets, and usually he ends up being right long term on a lot of those bets. So he bought Western Digital. I was waiting to buy some, so I bought a little bit as well, but just a small piece because obviously Western Digital is going to move with the overall market. If I still don't think the lows are in, that stock could continue to go lower. But man, from a valuation perspective, it's starting to look really cheap, and I like the 5.5% dividend. Not sure if that's safe or not, but hopefully it is.
All right, and that'll do it for our show today. If you missed any part of it, you can catch our podcast. We're on iTunes, SoundCloud, Stitcher, TuneIn, and Google Play. Just find it by searching for PreMarket Prep on any of those platforms. Please remember, all the information, material, and content on our show is for informational purposes only and not meant to be investing advice. Thanks a lot, Dennis. Thanks a lot, all of you in our chats, both on YouTube and premarket.benzinga.com. Thanks to Steve Sears for joining us today. Hope you all have a good rest of your day, and we'll see you on Thursday.